Hi, everyone. Welcome to your latest Glass Half Full. Sonu, we've had some wild moves in the bond market. Bonds sometimes are a little boring, but with everything going on, we're going to talk about the higher trending yields, which have been pushing bond prices lower. And we're coming up with a good title, a fun, playful title. We came up with Bonds Shaken and Stirred.
Yep.
Hopefully people like that. That's
Yes.
the
There's a
quality
lot
work we do.
happening there. Yeah,
There's a
it's
lot
been
happening
shaken,
there.
it's been stirred, it's been,
Mhm.
it's bond land, which is usually like watching paint dry.
Mhm.
It's seeing a lot of action right now.
So I'll set it up. The reality is bond yields have been moving higher this year. You'll dig more into the weeds of it. The 10-year yield, kind of the main benchmark yield a lot of people look at in bond land, we'll call bond land, and bond land was 3.94% right before the war started. Just recently, went all the way up to 4.6%. So that's a really big jump. We've seen jumps in short-term yields, long-term yields, geeky things we call across the curve. So, why are yields going higher in the U.S. and honestly higher around the globe too?
And to be clear, this is a U.S. Treasury yield. So you
Yes.
can think of U.S. Treasury yields as your risk-free yields in a sense,
Okay.
because you expect the government to pay you back, right?
Mhm.
So, and every other bond, whether it's and every other
James, whether
borrower,
it's James Bond
there's
or
James Bond,
yeah.
yeah. Every other bond is benchmarked to that, which is why U.S. Treasury yields matter.
Mhm.
Short answer to your question, Ryan, is bonds don't like inflation,
Yep.
right? And
Okay.
bonds especially don't like inflation volatility. Because when you have
Oh.
inflation, like if you tell me, you know what, inflation is going to be 5% over the next several years, okay, and I'm lending you money for 5 years, I know, okay, I need to get more than inflation as a return. So maybe I
Mhm.
charge you, you're a good borrower, you're a great guy, you're a good friend. Let's say, you know what, I'm going to charge you 6%,
Okay.
right? I know inflation is going to be 5%. But what if inflation turns out to be 7% or 3 or 8 or 9? That's a lot of volatility. Inflation, I don't know. There's a lot more unpredictability with inflation. And then I'm like, you know what? Instead of charging you 6%, I'm going to charge you for that extra uncertainty as well. I'm going to charge you maybe 7%. That's essentially what's happening. There's more inflation volatility. And this is happening globally, right? We could talk
Mhm.
about Japan and all that. But the bottom line is the Strait of Hormuz remains shut. So there's no oil flowing across the strait. The stalemate between the US and Iran continues. I mean, we see a lot of proposals going back and forth. The glass half full
Yep.
view is that they're still talking. The glass half empty look is that oil's not flowing still. And it's been 2.5 months. It'll be close to 3 months. Now, oil prices are above $100. Higher oil prices equals higher inflation, equals higher bond yields.
Well, that's right. I was going to make a joke. We could call it like the barrel half empty in the case of oil here. So listen, let's maybe take a step back just for a second. Why all this matters, yield prices go up, bond prices go down. They're inversely related and vice versa. Yields go lower, bond prices tend to go higher. And I mean, I'm going to assume everyone listening to this has some bonds in their portfolio. Some people have a lot more, some people have a lot less, but we're just going to talk assuming that you have some bonds in your portfolio, diversified portfolio. So year to date, Sonu, just as of like yesterday, all right, the S&P 500 is up like 7-8%, pretty good year. You look all around the globe, emerging markets up double digits, even with some big pullbacks recently. Developed international, so again, think Japan, think Europe, think Australia, up a tad less than the U.S., but still green. Even gold's up after some wild rides. Gold's still up, 5-6% for the year. And then bonds, specifically in the United States, are negative on the year. That's not the end of the world, but listen, as an investor, we don't really want to see that. So how does this work from a portfolio point of view, you think?
Yeah, and then to be clear, most of us own some form of bonds, right?
Yeah.
Whether it's long-term bonds or whether it's short-term bonds. I mean, a lot of us own
Mm-hmm.
money markets, for example, right?
Yep.
And CDs and things. Those are all essentially backed by bonds, right? Especially U.S. Treasury bonds. It's benchmarked to that. So bonds matter. Everyone has some amount of bonds in their portfolio, depending on where on your risk spectrum you are. And that gets to the fact that how do you traditionally lower risk in a portfolio? You move from equities to bonds. Now you
Yeah.
expect bonds to zig when stocks are zagging. The good news is, as you just mentioned, stocks are up, bonds are down. You don't really expect bonds to be down because
Mhm.
you expect to get your money back, right? You don't expect bonds to be negative. And right now, cash is doing better. But that gets to that part of we've talked about inflationary growth. During an inflationary growth regime, that's good for profits. It's good for revenues, sales, nominal GDP growth. So this is before adjusting for inflation. If that's running around 6%, that means sales are running strong. But that also means a good chunk of it is inflationary. And bonds don't like inflation. That's essentially what's happening, very simply put.
No, that's a great way to put it. And I think one more concept to build on. You think about, let's call it like the last 5 years, give or take. Starting in 2022, actually, right? The stock market had a really rough year. A lot of longer term investors might remember 2022, not a good year for your portfolio. It just is what it is. Sometimes you have a bad year. And Sonu, the stock market lost like 20% that year. The S&P 500 did. There were, I'm going to go by memory here, like 4 or 5 other times we lost like 20%. It happens. It's rare, but it happens. Bonds had spectacular years every single time, those other times. Now, what are the 4 most dangerous words? Sir John Templeton. This time is different. 2022 was different because yields went higher, the war took place, the Fed was aggressive, hiking rates, and bonds had, again, don't quote me here, but we can quote our friends over at Ned Davis Research, bonds had their worst year since George Washington was the president, all right? So your portfolio didn't do well because bonds didn't zig when stocks zag. And you fast forward a couple of the times we've seen stocks sell off the last several years. Listen, we've been in a bull market, but we have some bad weeks, some bad months. It happens. Bonds haven't always done that well. Just since the war started, like we said, stocks sold off a lot initially, right? Bonds, how'd they do? They didn't give you much because, again, yields went higher. So I think it's a real interesting point of view. The old school, I'll get to a question, so I'll just keep talking here. The old school view that people used in the old days, we'll call this old days, called 20 years ago, 60-40. 60% stocks, 40% bonds. Now, what we've been talking a lot about in this inflationary growth world, you want to own more than 60%. Not going to give too precise numbers because everybody has different, advisor, and everyone has different ways to look at this. But we'd say you probably show a little bit more than 60%. But that other bucket in the old days was just bonds. We don't think that's where you should be, and we haven't been, right, Sonu?
No, exactly. And that's why we've been preaching diversify your diversifiers. In an inflationary regime and a regime where you have more inflation volatility, inflation becomes less predictable. Yep. Unlike the last 2 decades, right? It's not just about low inflation. It's also about stable inflation, right? We don't have low inflation now. We have high inflation. We don't have stable inflation either. We have a lot of inflation volatility. That's when you want to diversify diversifiers. Again, like you said, without giving precise numbers, you want to have exposure to trend following strategies like managed futures, which give you exposure to things like commodities, whether it's cattle or grain or oil, obviously, right? These things can be volatile. So you don't want to put all your portfolio or all your diversify into this. We're not saying suddenly all your bonds either, but you probably want to have some cash as well, right? Cash is sometimes the best hedge. I mean, Warren Buffett has a lot of cash. I'm not saying that's a good thing. You don't want to have too much cash, but that's part of your diversifiers as well. Gold is another example of a diversifier. So all of this is, how to diversify your risk asset, which is stocks.
Yeah, I mean, there's a couple old sayings that being diversified is always having to say you're sorry. But there was a time, let's call it the last 5 years, where tech stocks went up a whole bunch. You might have said to your financial advisor, why in the world do I own anything besides these big 7 companies? Honestly, for a while, it's like, oh, yeah. Well, then you see why. Because of what we've been seeing lately, where the Mag 7 had some big sell-offs and other parts of the markets have done a lot better. And then you look around globally, and it's not just a U.S. story anymore, as we've been talking a lot about. So, we're probably near the end. How do we want to wrap up this conversation on, how about this? When the average person here is the 10-year yield's at 460, and the 30-year yield is like breaking out above 5% approximately, but 30-year highs. How does this really impact just the average person listening? All these higher yields across the spectrum.
Yeah, the 30-year is at 5.17%. That is the highest we've seen since 2007. Even across the 2000s, 2005, 6, 7, the average level is less than that. Now we could go below that again. Yeah, it depends on what happens. But look, short answer is borrowing costs. It increases because everything, almost everything you want to borrow against, whether it's a car, house, all of that, it's benchmarked against U.S. Treasury rates. And if U.S. Treasury rates are going up, Treasury yields are going up, that means all your borrowing costs go up. That's plain and simple how, rising yields affects everything. And rising yields, as I said, that's a downstream effect of higher inflation.
And there's a yin and a yang to everything, because potentially higher yields, what's that mean? It benefits who? It benefits savers, right? You can get more in your money markets. You can get more in different things, potentially to benefit if in those buckets. Now, there's a lot more we can talk about, but we probably do need to wrap it up. But we have a new Fed chairperson coming very soon. I believe Friday is when Kevin Warsh is supposed to be confirmed in charge of the Fed. And he has said that he's not too warm and fuzzy here about hiking rates. But we look and peel back that onion in the market, right? The market is suggesting maybe we do have a rate hike or two before the end of the year. Sonu, I've never seen you do this, but in 45 seconds, can you do this?
Probably not, but I'll try.
How tough of a spot is Warsh in here? I guess let's go that way. How tough of a spot is this for Warsh? If he wants cuts, but the market's saying no way and there's inflation, what in the world's going to happen?
Yeah, I just a matter of time. When I'm not saying the market doesn't mean the market's always right. You look at the 2-year yield.
Totally.
The 2-year yield is at 4.15%, above 4.1%. Where is the Fed's policy rate? 3.6. That means the 2-year over the next 2 years, markets are saying the average policy rate, the Fed's policy rate, should be above 4.1%.
Yeah.
That's about 0.5 percentage points above where the policy rate is right now, which is why the market's expecting hikes. And it's just a matter of time as to when Kevin Warsh cries uncle here. We'll see.
Yeah, and get your popcorn ready. But we'll sum it up like this. And we've talked about this a lot in these other video series we've done here on Glass Half Full. The economy's doing well. Earnings are still strong. Manufacturing numbers are strong. We just had retail sales came in solid. Yes, consumers don't feel good if you look at some of the soft data and the surveys, but you look at the hard data, what people are really doing. And at the end of the day, we are overweight equities. I'm assuming most people listening to this probably are as well and really want the stock market to do well. We were hitting new highs not that long ago. We sold off a little bit. Listen, we just had a huge rally in 7 weeks. One of the strongest 7 weeks rally ever. Maybe I'll end with this. We're in the middle of a 7-week rally. Now, I don't know. Maybe we're going to be down this week. It happens. We probably do. It's okay. Up 7 weeks in a row, Sonu, up 16% during those 7 weeks. It's one of the largest 7-week win streaks ever. Now, here's what matters for everybody. We found 7 other times in history we had a 7-week win streak, and the market, so S&P 500, was up 10% or more during that streak. And we can put this video, or we can put these numbers on the screen right now. 1 year later, Sonu, the stock market has never been higher. Wrong thing. Never been lower. Apologies. That's why it's live. It's live. Sorry about it. Never been lower. And the last 3 times you can see we're up like well over 20% a year later. We're not saying we're going to be up over 20% a year later, but we are saying the strength we've seen is consistent with a continued bull market like we've been laying out for a while in the Glass Half Full series. But maybe with yields higher and some of the uncertainty over the Fed and what he wants to do and the war, maybe we take a break. That's okay. After the rally we've had, that's perfectly okay. Sonu, wrap this up. How do you want to finish it?
Look, markets just can't keep going up, even though, we're obviously bullish. Volatility, as we've talked about before, is the toll we pay to invest. Is the toll we pay for higher returns. Is the toll we pay for stocks to have higher return than bonds, especially, right? Yep. But, bond prices going down, bond yields going up, part of that depends on what the Fed will do. But yeah, you could see some volatility here, but that shouldn't be a surprise.
I mean, who says bonds are boring? We've gone like 13 minutes. It's like one of the longest one of these we've ever done. I was like, I don't even know what we're going to say about bonds. Here we are 13 minutes later. I guess we said something.
And we ended up talking about stocks anyway.
Yeah, we talk about everything else too, I guess. That's how. But listen, thank you everyone for watching these weekly Glass Half Fulls. We're going to continue to do them. We are aware yields are higher. There's uncertainty. Bonds have not done well. But we're going to get through this just like we've gotten through all the other problems and crises throughout history. And we'll keep talking about it every single week in these. With all of that, everyone, enjoy your week. We'll see you next week. And by the way, it is May-cember. You have a child graduating like I do from high school, like right now. This is crazy time. So good luck to everyone. Congrats all the graduates out there. It is graduation season, and it's very stressful on the family. I promise you that. I know that because we're dealing with it right now. But congrats to all the graduates. We'll see everybody next week. Take care. Thank you.